Hey everyone, how are you doing today? Hope you're doing well. Before we get started, do me a favor and hit that like button. If you're not a subscriber, do me a favor and hit the subscribe button. A notification bell also next to it so that you won't miss the episode. Also, check out the link below. So today I'm going to talk about assumable mortgages. I am having technical difficulties today. My screen is completely black, but I am assuming that you can see me. Um, if there's a tech person out there, let me know how I can make my screen normal. Because from my view, it's completely black, even though all of there's nothing covering the openings. So let me know if you're a tech person out there. All right, so I'm going to move on. I'm going to be real brief. I'm going to talk about assumable mortgages. So, what is an assumable mortgage? So, this is when you take over somebody else's loan. And the benefit of taking over somebody else's loan is that you get that low interest rate that they paid because they bought the house a long time ago where interest rates were low. So you're getting that low interest rate and that low monthly payment. So a low interest rate is connected with a low monthly payment. So that is the benefit of taking over somebody else's loan, or essentially what is called an assumable mortgage. So I'm going to give you an example. Say that you're going for a home that is $186,000. All right. Say that the seller, they still owe, we'll say 175,000. So the home is worth 186,000 and the seller still owes 175,000. So subtract this 175,000, and this is what you have to come out of pocket with. So this would be the only con of assumable mortgage, is that you have to come up with the cash to pay the difference, right? In this instance, it's not really bad, all right? In some other instances, the owners will have more equity in the home. So you would have to come out of pocket with more money. But this is just an example that I made up. The the home, again, it's worth 186,000. The seller paid, the seller owes 175,000. So you subtract how much they still owe on it. 186,000 minus 175,000. And then this is how much you would have to come out of pocket with, $11,000. So again, the benefit is you get their low interest rate and you get their low monthly payment, as opposed to just buying in the market right now where we're having high interest rates. You can get that low interest rate and that low monthly payment because you took over somebody else's loan. So this applies to FHA loans, like if the house was under FHA loan, those are assumable. Also, VA loans are assumable. Also, USDA loans are assumable. So you as a buyer, you would go through that seller's same current lender to see if you would qualify for taking over their loan. So when it comes to paying this difference out of pocket, people get the money from various ways. Perhaps you already have the money in your bank account. There's other ways like equity in your home. If you own a home, equity in your home. There is borrowing money from the 401k as a resource. There's taking out a personal loan as a resource. Some people have family and friends that they can go to. Um, and then some people have partnerships. Some people are working together as a team. Maybe you're married and you have a team thing going on. So there's different ways to get this money that you would pay out of pocket. So as it goes for FHA loan, if you're taking over FHA loan, you would still be required to pay PMI. However, if you're taking over a VA loan, there is no PMI associated with that. And so that is an assumable mortgage in a nutshell. It has a lot of benefits in that you are taking over somebody else's loan and you're getting this low interest rate. So as a result, you're taking over their low monthly payments. You would take over their terms the way they have it already. So say for example, maybe they were in the house for let me see, maybe they were in the house for 25 years. Well, let me just say, you take over the same terms of their loan. If they have 20 years left on that loan, then you're taking over their loan. So you would have 20 years left on it. So you would have the exact same terms of that loan because you're taking over their loan, right? So the time length is the same, the interest rate is the same, and the monthly payment is the same. And so that is the assumable mortgage in a nutshell. Again, FHA loans are assumable, VA loans are assumable, and USDA loans are assumable. And you as a buyer, you go through that seller's current lender and you are taking over their loan. So that is one of the options out here in the mortgage industry. So there are several different options, but this is just one of them. And this is called the assumable mortgage. All right. So do me a favor before you leave. I need for you to hit this like button. What that does is it helps other people to see the channel. Also, hit the subscribe button and notification bell next to it so that you will not miss an episode. Check out the pin link below and feel free to leave any comments. Feel free to let me know your thoughts, your opinions. All right. Again, before you leave, don't forget, hit that like button on your way out. Also, any tech people out here, if you could tell me how to get rid of this black screen, like I'm seeing a black screen, but I believe that you can see me clearly. So any tech people out here, let me know how to get rid of this black screen that I'm seeing. Like none of my openings are not covered up or anything, and I'm still seeing the black screen. So let me know. All right, on your way out, don't forget, hit that like button. All right, thank you for watching. Have a good rest of your day. Bye for now.